Joining us now is Michael Kushma, Morgan Stanley Investment Management CIO of Broad Markets Fixed Income. Michael, incredibly different tone today than if the year had ended on, call it, August 15th, isn't it?
It's the mirror image. Earlier this year in September, with strong growth in the U.S. in the third quarter and accelerating growth, it seemed. The Fed raising rates likely again. 10-year bond yields at 5%, 2-year notes at 5%. It looked like another dire year for fixed income, and it all turned around in the fourth quarter.
So where would you find the most value then? I was even reading David Zervos' note over at Jefferies, but he's talking about, looking at fixed income and kind of where you'd want to be positioned in 2024 for this kind of soft landing period we appear to be going through. What would you say?
Well, it seems to me that it's very, very likely the Fed cuts interest rates next year. Inflation is coming down. The economy is decelerating into next year. We don't know how weak it'll be, but it is decelerating from the pace in the second half of 2024. The question is when and how much is the Fed going to cut interest rates? Right now, the market is very aggressive on rate cuts occurring even in the end of Q1 in March of next year, which seems to be on the early side. There's no reason for the Fed to panic and have to cut interest rates unless something really strange happens in the world. So we would say that overall, higher quality bonds, even high yield bonds, are looking pretty good, but don't expect the returns that we got and it looks like we're going to get in 2023 to repeat in 2024. So we're not likely to see the level of long-term interest rate drops that we've seen lately in 2024.
Michael, do you expect there to be money coming from the money market funds into the Treasury market, into the corporate bond market, or will it not pass go and go right into the stock market?
It's a very good question. There's a lot of money sitting in cash, as you might think, with interest rates as high as they are in money market funds, over 5%. Why extend maturity? And that was the right strategy until Q4. And I think there is a potential a fear of missing out, that you don't want to be sitting in cash when cash goes from 5.5 to 4 next year, potentially. And equities are up, 5 to 10% next year, and bond yields are down another 25, 50 basis points, generating, again, superior returns to cash. I think it's more likely to go into investment grade bonds in particular. I think it might jump all the way from cash to equities, but equities are the riskier end of the financial market spectrum. So I think the intermediate jump would be to corporate bonds, both investment grade and high yield, which are still offering attractive yields from a long-term perspective. Again, they've come down a lot. We were talking about 5% plus yields and inflation on its way to 2, a 3% after inflation real yield on high quality corporate bonds looks pretty attractive. So I would think that would be the part of the market which attracts the most interest the soonest.
So that's an important distinction, because you're saying is, don't be mad that you missed the high yield rates. You be thankful, I guess, or jump on the opportunity that you're getting still or a good real return, because the reason the Fed will be cutting rates is because inflation is coming down, which flatters your nominal yield, right?
Exactly. And because the Fed has providing a somewhat of a put on the economy, they're saying we will be cutting interest rates, even if the economy does okay next year, the probability of a recession next year is dropping. And that's very supportive, as we've seen, for equities, for corporate bonds, high yield bonds. It's good for all those elements. Not so good for U.S. Treasuries, because if there's no recession, the amount of rally you can have in Treasuries is somewhat circumscribed.